Dhirendra Kumar, the CEO at Value Research. He joins us on the show right now. And Dhirendra, morning, when you see the Nifty crack 2%, the Dow crack, and thereby the Nifty crack even further, you always wonder, are DIIs going to continue to support this market? How sustainable are the flows is the key question in everyone's mind. What is your own take on this?
No, my take is that these are still early days of the domestic investors' flows into mutual fund, and the factors which drive this growth is fairly straightforward, and they continue. They prevail, they continue, and so the charm will, there. Interest rates have come down. The TDS getting in force. So, people are realizing the need for getting a market-oriented investment. And there has not been a disappointment with mutual funds at all so far, despite the intermittent corrections. And so there at best, if you look at the component of flows into the market, the SIP is still not a very significant component of the kind of money flowing into mutual fund, but it is quite meaningful and sustainable. So that will provide a very good base for investors, because the money that has come through SIP is also very patient money that is unlikely to go out of mutual fund in a hurry. But there could be a deceleration, but all the variables which is primarily been a catalyst to the flows into the market through mutual fund, they prevail. So I am very confident that of course all this is entirely based on the fact that we have not seen any big correction or of a sustained kind. And investors, the kind of money coming in, they are not impatient, they are not expecting quick return. In fact, quick return came when investors were not investing, or they were still pulling out. If you look at 1.5 years, 2 years build up, this mutual fund Sahi Hai campaign, the declining interest rate, and the decline in gold and real estate, that is, I have come across so many investors who are now rethinking all that they have done in the last 10-15 years.
So one part of the story that Indians are revisiting equity as an asset class, but for every buyer there is a seller, and for every seller there is a buyer. Now when Indians were buying gold, FIs were buying Indian stocks, and when Indians are buying stocks, FIs are selling those stocks. So I'm not getting into an argument of DI versus FI, but to assume that markets will go higher because Indians are buying stocks may be slightly early, because the supply also is coming from FIs and from new issues.
No, undoubtedly, just if we do not, over a period of time, I think corporate earning is the primary driver of stock prices going up, and these dynamics can be favorable or unfavorable for a given period of time. And not to mention that with just inflows, you need even larger inflows if we do not have earnings going up. So that apprehension remains. But will investors pull out in a hurry? How different it is from all the past bull runs that we have seen, which was primarily driven by investors pouring money into mutual fund. This time it is definitely of an unusual kind, in the sense that SIP book has been built up. It has been a gradual build up. A lot of investors are coming with the right orientation. We don't see the preference for a sectoral fund. If you look at 1994 or 2000, which was entirely a narrowly tech driven boom, or 2007, which was entirely infrastructure, the story which evolved to collapse. So this time around I find that investors' preference for something very basic.
Dhirendra, I'd like to draw your attention to the fantastic job some of the balanced fund managers have done. Whether it is Prashant or Naren and his team, for example, ICICI Prudence or ICICI, HDFC Prudence, I beg your pardon, HDFC Prudence, or for example, what ICICI Prudential Balanced Advantage Fund has done. So do you think that is the most important and the biggest cushion for this market? Because when market valuations are strong, they increase debt allocation. When markets come down, that money automatically moves back into equities.
Yes, this has worked out very nicely for investors, and it is actually proving to be very beneficial to the fund companies, because fund companies in the past, last decade and a half, they always looking at in a fairly opportunistic way. And it is very unusual that this mutual fund Sahi Hai campaign has aroused great interest among investors. Everybody has become curious, also being driven to think harder about how to optimize their return. And these are just the right kind of vehicles, because the first time investor, we have large population which has never experienced this, or whenever it has experienced it, it has been disappointing. So these are actually these are just experience enhancing vehicles which has come in very handy. They will also have their ups and downs, but not of the severe ups and downs that investor is extremely uncomfortable with. Most investors are very comfortable. They actually look at previous declines as an opportunity loss, but they are always fearful of the big decline that can happen in recent future. So this is a mindset which these funds are able to better address. And the abstinence of most individual investors, for first time investor, avoiding the exotic kind, the small cap fund and the mid cap fund of late, and starting with their only with their SIP, that has actually enhanced their experience. This has come in handy. Of course, balanced fund has a great advantage if markets become very turbulent in the absence of earnings growth, because if you look at certain segment of the market, I would not say that they have not witnessed steep correction, but a balanced fund which is fairly diverse with a 30, 35, 40% sometimes into or almost up to 50% into fixed income through the arbitrage allocation, they are able to benefit from these interim corrections, and investors are getting a superior experience. I think we need there are different kind of investors where fund companies are still chasing that big investment coming their way. That could be injurious, and that is something which is a vulnerability. If we see a sustained 25% correction, how many investors will pull out, and that will be the real test. But I think the SIP book that has been built up is very comforting.
Dhirendra, I was just looking at the category-wise performance, and it's startling to see that it's actually small caps which have given you the best returns. Even if you were to look at the 1 month performance, the equity small cap category has surged about 1.79%. On a 3-month basis, almost a 2.5% return. And on a 1-year basis, it's a staggering almost 22% return. And now with the markets getting a bit of consolidative, getting a little volatile off late, as an investor, you worry that is it time now to pull out of small caps? Is it time to avoid the racy stuff? What would you tell viewers and investors who are looking to seek that advice for small cap investments?
No, I think good small cap funds will deliver superior return, and if an investor is taking a 5 to 10 year view, and if he is investing regularly, because most of these returns came when everybody invested when there was great disbelief in the small caps. So if you are a regular investor through the bad times, if you are that courageous, if you have the heart, then carry on. But most investors, the kind of investors we are referring to in India, the mutual fund investor who has never invested in the market, he has been a fixed depositor, and he is just after demonetization and in the real estate crisis, that is because real estate was a very significant part of everybody's financial portfolio. Real estate wasn't a home, and most people are faced with a situation that they don't have the home and they don't have the money. So whosoever is able to realize a part of it or all of it is going to keep away, and those people, many people looking for income from investments, small caps are not the ones to actually derive a return. In fact, if you look at one thing that has happened very substantially, that investors are, old investors are investing in balanced fund, and they are beginning to believe in the dividend derived from those balanced fund. That may not be the right strategy, but that is not a downright dangerous strategy either, because for investors it is important to enhance their return and derive it in a more tax efficient manner. The dividend yield on many of the balanced fund could be about 3-4%, which is not a very big drawdown or a withdrawal rate. So it may not be the most desirable desirable expectation for which investors are coming to them, but that is definitely not going to be a big blow whenever the market corrects. And for most investors, that will be the right way to get started and be there. not get attracted to the small caps and the mid caps, because that is past.
Right. Dhirendra, you've always been a fan of that conservative approach. Whenever we've chatted, you've said that balanced funds are the way to be. If you're looking at a pure equity play, it's got to be multi-cap. Do not restrict yourself. Do not concentrate your portfolio in just large caps or small caps. So give us some names. What could one look at right now? If one is looking at an investment in a conservative fund, what are your top 3 names?
Yeah, I prepared a list for you. If I have to list the best conservative funds, and this is a combination of the large caps and the balanced fund, which comes to my mind. I have listed 5-6 of them: Birla Sun Life Frontline Equity Fund, Franklin India Balanced Fund, HDFC Balanced, ICICI Prudential Focused Blue Chip, and L&T India Prudence Fund, and SBI Balanced Fund. These are the large caps and the balanced fund which will be suited for most conservative investors.
Let's talk about 2 more categories. They're in the growth funds and tax saving funds. Now, tax saving funds need no introduction, but when you say growth funds, what exactly are you trying to indicate here? I mean, these are high risk, high return, equity diversified schemes?
No, these are actually funds which invest in, they are multi-cap funds or mid and small cap fund, and they are so I have just simplified it, because most investors don't understand the 7 categories that we say, that this is large cap, this is balanced, and this is actually the dynamic balanced. And investors have a slightly different orientation. They are conservative investors. They want good returns with great stability. They want good returns with reasonable, if not reasonable stability. And so, it is with this in mind, the investors' thinking process, their expectation, that I am looking at growth. I am listing these growth funds. They come from all variety. Of course, the fund which I am listing, they have impeccable track record. They have been through a full market cycle. They have been able to withstand a market decline better. They have also been able to participate or do much better than most other funds in a rising market, and that could be, and these funds have been able to demonstrate all this over the last 7-8 years, which has been fairly turbulent. If you look at last 1.5 years, 2 years, it has been exciting, but there were bad period, and they have done that consistently. Listing those funds: Franklin India High Growth Fund, Kotak Select Focus. It has come into prominence of late. Mirae Asset Emerging Blue Chip Fund. This is a mid-cap fund, but has always taken a conservative, fundamentally earnings-driven approach. Motilal Oswal Focused Multi-Cap 35 Fund. A multi-cap fund and reasonably into large cap, but it still beats the performance of most mid-caps even with its approach and selectivity. Principal Emerging Blue Chip, emerging as a fairly attractive fund of late, and SBI Magnum Multi-Cap Fund.
Okay, Dhirendra, great speaking with you, and thanks much for bringing about that clarity that all of us were looking for right now. You tend to get a little scared and worried about your investments when the markets do begin that consolidation phase.